I don't want this thumbnail to seem super striking and that I think the market's going to crash and that, it's going to be as bad as 2008 or that, maybe it's going to be like the Great Recession, because I really don't see that. But I did take a pretty aggressive put play against the market. This is for a couple reasons I'm going to go over. One is it's not even really that I see the market dying here or anything. It's really just to hedge my portfolio. So, for you guys who are part of my Facebook group, I'll put the link down below because you should be. You guys know that in the public portfolio, we have a good amount of our money in the market. Hedging with a long-term account is something that's very important and that not a lot of people do. And I'll be completely honest, I don't really normally do it just because I'm never really that deep in the market. On the public account, we have $26,000 now, and I really at any time I'm only in for about half of that. Just now, especially because we've been on this bull run for so long. Last December showed that we can make a pretty quick correction very quickly, and I think it's good to have a good amount of cash sitting on the side. Now, a lot of people normally say 70% in the market, 30% out. I'm usually 50-50 or 60-40, but I wanted to explain how I decided to hedge and why I specifically picked this option. So here's a screenshot of the option. I think we're down like $20 on it right now. So as you can see, those of you who understand, I am making an options beginners kind of video, then that'll come out tomorrow. But for you who do understand the Greeks are pretty good. The expiration is in March, and this thing has to fall pretty far to hit my break even. And so especially today when we're at all-time highs, this specific contract was much cheaper. I think it was like $60 or $70 cheaper than when I was looking at it last night. And so I'm not a fear monger. I'm not, the whole market's going to die. But if we look, we'll talk technically first. If we look technically, we have what is called as a rising wedge. And normally with a rising wedge, we will see higher highs and you will see higher lows. But unlike a channel, which looks like this, where you have an even amount of highs and an even amount of lows, and the stock, moves up. As you can see, we're starting to come to a peak here and what's called an apex. So it's starting to get smaller and smaller until eventually right around here, you can't time it specifically, but right around here is where we're going to see a lot of pressure and a squeeze will most likely occur, and we're going to have to see, okay, where is this going to squeeze to? Some could say that if this continues to happen, we could see a huge breakout. And yeah, I mean, we could. That could happen if, Q4 earnings are phenomenal. It could happen if not only a phase one deal comes out, but a, big China trade deal in which everyone wins comes out. I don't really see that happening. And overall, the economy is doing pretty good. So yeah, that could totally happen. And I think that that's why a lot of people are still long. You don't see massive selling or too much profit taking right now. But technically with this pattern, what you'll see is it'll bounce down, it'll come back up, and then usually it'll break. Now, the way you play this pattern is you usually wait for the break. And then if it breaks and holds under here, say I'm terrible at drawing, especially on TOS, but say like this is a little candle, the candles break down, and then it pulls back up. That is usually when you buy in, and then you'll set a stop loss up at new highs, because at that point your pattern, your trend is completely broken. But here, normally you would buy in and then you wait for a sell-off. Now, remember what time frame we're on. We are on a weekly time frame, right? Think about that. Each one of these is 1 week. So you only get so you only get 4 of these in a month, right? This moves very, very slowly. But the way in which patterns work is that the pattern really becomes stronger and more defined the further out you go. So a 1 hour pattern isn't going to have as much validity as a 4 hour pattern, and the 4 hour pattern is not going to have as much as the daily, and the daily is not going to have as much as a weekly, and the weekly is not going to have as much as a monthly, just because that's how it tends to usually be. And so this is a pretty strong pattern. Now, you can't trade fully off of technicals. Technicals do work, but it is a probability game. And so fundamentally, I want to talk about why I got this. Quickly stated before, I do think the market is going to pull back pretty heavily in November and December and possibly January. But like I said, I don't think it's going to be a monstrous dump. I don't think SPY is going to go down to like 270 in 2 months or something. That's a little crazy. But while I'm overall bullish, you have to think about it this way. This is $1,000 play, and I have $25 extra $1,000 sitting around, and about 12 or 13,000 of that is in the market. So think about it. In the market right now, I have $12,000 actually deployed, and I have $1,000 against it. So just statistically thinking, do you think that I'm overall bullish or that I'm overall bearish? You're right. I'm overall bullish, okay? Because I'm in for 12,000 and I'm shorting with 1,000. Now, the reason I took this is because, yes, I do think we're going to have a pullback within the next month or two, and I want to hedge. So that means that, if my actual shares of stocks start to fall, my portfolio is going to be pulled down, and which means that if I have this option, it is going to the option is going to go up in price, which will probably try to balance out my portfolio. That's what I'm looking for. If there is a downside, overall the portfolio will stay relatively the same, or I'll at least mitigate my losses. Now, let's say the market rips, right? Like a trade deal goes through, Q4 earnings comes out, everything's amazing, sentiment is high, the economy's still booming, housing's great, right? Okay, well then my stocks, my underlying stocks that I have are gonna rip and go up in value, but I'm gonna lose $1,000 on this put, which means I'm not gonna really get as many winnings, and I'm not gonna make as much money on my longs as I wanted, but at least I had some sort of insurance to the downside. And that's what hedging is. Hedging is essentially insurance. So now I want to go over the fundamental reasons why I think the market will pull back. First is this phase one trade deal. This trade war has been going on for what has seemed like forever. We seem like we start to go somewhere and then sentiment changes, or people pull out of deals, or the one side wants more. The last month, this phase one trade deal was supposed to happen. It was supposed to be signed in Chile. It was supposed to be mainly over agriculture. I personally think the phase one trade deal is a load of crap. Long story short, it didn't happen. Now we're getting news out of China saying they're pretty pessimistic about it happening. And as always, Trump is saying the opposite, where, he's pretty optimistic about this happening. Personally, I think the phase one trade deal is just a way for Trump to get his foot in the door so that during the presidential elections, he can say, well, I've done all this with China and we just have them. I need more time. And if the Democrats get in there, we're going to get ruined like we have been. Intellectual property and trade is going to continue to be terrible with China, and we're going to end up getting screwed. And that's going to be his way to stay in presidency. So I don't think that the trade deal, a phase one trade deal, happens. I really don't. And if it does, I still don't think the market's going to really respond the way that people think. And the other thing too is that, the market's already priced in a phase one trade deal. So if this doesn't happen, or like I said, if it does happen, but not in the best possible way, we're going to see a pretty huge pullback. The mental reason that I think something might occur is just because of earnings. As you saw last year, when the market was dying, what really saved it? What was the Santa rally? And that was earnings. Earnings were great, and earnings really make investors, feel more confident about having money in the market and not having money on the sidelines. Because you have to think about it. Basically, when things get shaky, people start pulling their money out. And I think that earnings will either really help or hurt this, especially if a phase one deal doesn't happen and earnings are bad. People are going to start pulling the money out of the market left and right. And so the other thing too is this overall profit taking, I think, is going to happen. I mean, even if you just looked, if I showed a monkey this graph and I said, hey, do you think stuff's overvalued or undervalued? I mean, pretty quickly, we're at all-time highs. You would think that a lot of stuff, a lot of stocks and a lot of companies in the market are probably overvalued. And a lot of these big banks and these big investors are probably going to have profit taking, and also because of, fear. Fool me once, shame on you. Fool me twice, shame on me. This time last year, like right around this time last year, the market started selling off pretty heavy, and people might have some PTSD. I mean, the market really, really did sell off very, very hard. I mean, just even look, right? Like this was, where are we at here? Was this last year? No. This was last December, right? So from highs to lows, we sold off 17%. And on something like SPY, that is insane. SPY only on a good year goes up 7%. So think about it that way. There could be a lot of fear. There could be a lot of profit taking. And my other and final reason is the presidential race. I have these expirations by March, and by March, we will really see who the front runner is for the Democrats. And a lot of people are saying that if Elizabeth Warren is a front runner or the primary runner against Trump, that the market is going to die, or not crash, but the market is going to sell off hard. A lot of billionaires and a lot of people who run the market do not want Elizabeth Warren to be president. They don't want Elizabeth Warren to be running against Trump. And a lot of it is for good reason. And so I'm not saying overall that I think the market's going to die. I mean, we're at a point right now, and you guys know too, I say all the time, a lot of the market is luck, and we can't control it. Like really, I mean, none of us have enough money to control the market. You're really just on for a wild ride of these billionaires and market makers and politicians. And so for me, that is my hedge. That's why I'm taking it. The risk versus reward, which is something I always talk about, is there. I want to know what your guys' thoughts are. Are you planning on hedging? Are you planning on just taking puts because you think the market's going to die? A lot of people think that. Or do you think that maybe 2020 will be a slow year and we won't have much growth, and that could be the beginning of the end? I want to know what you guys think, what you guys are planning to do. Comment down below. Make sure you like and subscribe to this channel and to this video. I love putting out content for you guys. I love doing this. I'm putting a lot of time. I'm not even kidding, like 6-7 hours a day, because I'm trying to get 4 videos out a week on YouTube. I put all of my trades out on the Facebook group and on my Instagram. I'm working my ass off for you guys. I'm really happy. I'm really excited. Thank you guys. Have a good Thanksgiving.